In this video, we're diving into a crucial topic for all options trader, really understanding what defines our approach, defining our edge. And I'll get straight to the point. Understanding this concept is absolutely vital for your success as an options trader. You see, this is the most important thing that you need to know. It's like every other business. Every business has some sort of an edge that gives them an advantage when it comes to the market vis-a-vis the competition. So let's talk about, before we jump into options trading, let's talk about how casinos and insurance companies make money. Now, you might be wondering, what do insurance companies and casinos, what do they have to do with trading options? Stick with me and it'll all make sense pretty soon. Now, this video is a little bit longer, but it's really the cornerstone of what we do here at the Income Option and of your success as an options trader. So how do casinos make money? Let's start with first to understand how casinos make all the profit that they make. Right? It's actually very simple. Casinos make money by exploiting tiny probability imbalances in the hundreds of games that they offer. What are probability imbalances? It'll become clear very soon. They basically manipulate either payouts or odds. For instance, if the chance of a coin landing on heads or tails is 50%, the casino might pay you 10 rupees for heads but take 11 for tails. So they rig the games in their favor, or they adjust the payouts based on the likelihood of an event occurring. So as I said, for a coin flip game where they might pay you 10 rupees for heads and take away 11 rupees for tails. Now that's very obvious, everyone can see through it. So what they do is they hide it within the games, the design of the games that they have. So let's take an example and see how this all plays out. We'll look at how they do this in the game of roulette. Right? So you've probably seen that big wheel with a little ball in a casino. So a roulette has these 36 number spaces in black and white. But here's the kicker: they also have these green ones. Right? So most places have these green spaces like zeros, double zeros, or triple zeros, which sort of tip the odds in favor of the casino. Sure, you can bet on black or red, which is a popular choice with a 1:1 payout. So if you bet 100 rupees and win, you get 100 rupees more, making a 100% profit. You bet 5,000 rupees, you get 5,000 back with a 5,000 rupee profit on top. That's a 1:1 payout. So in a fair game, you would expect a 50% chance of landing on black or red, right? Well, in most cases, the odds of winning with a black or red are just 46.37%. Why? Because of those pesky extra green space in the wheel, zero and double zeros. They mess with these odds. So even though you have a total number of 18 numbers in total, you still have a probability of just 46.37%. This tips the balance in the favor of the casino. So in roulette, casinos both skew the odds and shortchange you on the payouts, ensuring that they come out ahead every time. Now this is just one example of how casinos make their money. And here's a breakdown of the odds for various combinations on the wheel. The probability of landing on a red or black is 1:1. The payout is 1:1 with a probability of 46.37%. That's your chance of winning, right? Even or odd numbers like 135 also have a 1:1 payout and a 46.37% chance of success. But here's the catch: they conveniently leave out the green spaces, zero and double zeros, from these calculations. These aren't even or odd, they're just zero and double zero. That's where the gains are. That's where the casinos have an edge on every spin of the roulette wheel. So as you can see, the odds are stacked against you when you're playing roulette in a casino. It's not a fair game, and understanding these principles will help you grasp the importance of defining your edge when it comes to options trading. Now let's look at something that is very rarely discussed in the trading industry. Why do casinos impose table limits? Now, table limits are a maximum bet that you can place on any one table. And it's a crucial point that often flies under the radar. Nobody's really discussing this, but it's absolutely essential to understand. Casinos set these limits to boost their advantage, increasing the edge that they have. Here's the deal: the longer you play, the more you're likely to lose. increasing the number of plays a person will make will ensure that the casinos keep that edge with me. It's as simple as that. Casinos use table limits to control how often people play their game. So they might cap it at $100, 100 rupees, 1,000 rupees, or maybe 10,000 rupees, but they always have a table limit. But why? Because they don't want you strolling in and betting 1 crore of rupees on a single spin. That's just too risky for them. For that one shot, they might win, but at the end of the day, it's too big a risk. So what they do is, or what they prefer is, if you come in and wager that 1 crore, put the bet that 1 crore in say 100 or 1,000 rupee at a time. They'd welcome that bet any day because they know that over time their edge becomes more substantial with more plays all round. That puts the casino's edge into play. They understand the odds. They know the design of the game, but they won't risk it on a one-off outrageous 1 crore bet. They'd rather let you lose that 1 crore gradually over 100 or 5,000 rupee at a time, because they know that the longer you play, the more you're likely to lose. So to understand this, let's break down the numbers for roulette. When you spin the wheel for the first time, you're theoretically at a 51% disadvantage. Yes, that first spin is your best shot at making money in a casino, and it's only about 49% chance. This percentage, of course, can vary depending on your bets, whether you're betting on black or red or other numbers, and how that roulette wheel is designed at that particular casino. However, your edge diminishes after 100 spins. At that point, 64% of players find themselves in debt or without more money than they started with. Think about that. After just 100 rounds, the casino's profitability and consistency increase while yours as a player decreases. By the time you've seen 1,000 spins, which requires quite a bit of time by the way, the casino's chance of making money stands at 81%, and your likelihood dwindles to just about 19%. But here's the real eye-opener, and really how the casinos are making money. After 10,000 spins, there's nearly 100% certainty that the casino will walk away with your money. This is a crucial point. The more you play, the more the odds stack in favor of the casino. So let's look at the math behind it. What is casino math, right? So let's imagine that there is a table limit of 1,000 rupees, right? So every table has a limit, and in this case it is 1,000 rupees, right? Now, after 100 spins, as we saw, there is a success ratio of 64%, and we're looking at it from the point of view of the casino as such. So the success ratio is 64%, and the risk to reward ratio, what they call the payout, is 1:1. So if the casino wins, they keep your money. If they lose, they have to give you their share of the money. Now, the potential profit, therefore, per spin is this 1,000 rupee table limit at 1:1. So 1,000 rupees is their profit, and the potential risk at the same time is, or potential loss is 1,000 as well. So they will either make 1,000 rupees or lose 1,000 rupees. So after 100 spins, what is the situation? Well, after 100 spins, they have 64 winning trades or winning spins, and they will win 1,000 rupees for each of those, giving them 64,000 rupees. And the loss after each of these 100 spins will be 36% risk that they had. And again, they will lose 1,000, giving them a loss of 36,000 rupees, which translates into about 28,000 rupees of profit. That is how it all comes together. But look at what happens after 1,000 spins. After 1,000 spins, their profit or revenue, however you want to see it, is 810. So out of 1,000, 810 are winning trades. Again, at that 1,000 rupee potential profit, they will make 8,10,000 rupees. At the same time, when they lose, and they will lose about 190 times, they will lose $1,000 each of those spins, or each of those losing spins, giving them a loss of 1,90,000, and that translates into 6,20,000 rupees of pure profit. And obviously, with 10,000 spins, it's almost a certainty that they will land up making money. That's 10,000 into 1,000. You do the math. Think about this. Think about it logically. This is why casinos entice you with free rooms, food, and shows. They know that as long as you stay there for an extended period, they're almost guaranteed to win. They have the odds on their side, and it's only a matter of time before they have enough people playing to secure their profits. They put these revitalizers in the air conditioning, they play the right kind of music to make you want to stay there and create that euphoria so that you stay in those casinos. They want you in the casinos. They give you free drinks, they stage the shows. It all makes sense when you consider how they maximize their edge. And think about it. Think about the millions of dollars that they spend just building those casinos, those large lavish casinos, right? Because the money exists, the profitability is, or the profits are guaranteed. Now, how do insurance companies make money? Let's shift our focus to now how insurance companies rake in those rupees, rake in those profits. And it might seem unrelated, but understanding this process sheds light on how options traders, that's what we're here for, how options traders can also profit. So insurance companies make money thanks to their secret weapon, actuaries. Right? So these folks dive deep into statistics and probabilities. They assess things like the likelihood of a 30-something male living in Delhi with a family history of heart disease, and what is the probability of such an individual meeting an untimely end before turning, let's say, 60. It's all about crunching those numbers. It's all about understanding probabilities. So actuaries therefore calculate the expected probabilities, right? So such as the odds of you passing away or your house catching fire. Now this principle applies across the board, but let's focus on life insurance as an example. Now you've got two possible outcomes. You either live or you don't. Blunt but true, right? Now if the actuary crunches the numbers and determines that there's a 0.25% chance you'll pass away in the next year and you hold a 1 crore policy, here's the breakdown. If by some unfortunate chance you do pass away with this 0.25% likelihood, the insurance company has to pay 1 crore to your beneficiaries. So based on the expected probabilities, they look at what the potential loss is going to be. So in this case, the expected probability multiply the potential loss to the company. The expected payout is 25,000 rupees if you pass away. In the flip side, if you continue to live with a 99.75% probability, it doesn't cost the insurance company anything because they haven't charged you a premium yet. They're essentially saying, if we pay out 1 crore when you die, how much do we need to charge you today to make a profit? This is where the premium pricing comes in. This is where they understand how the probabilities are coming in. Insurance companies need to determine how much they must charge to stay profitable. They already know the probabilities. They can't change those, but they can tweak the payout to ensure it works in their favor. So they might charge you 25,000 rupees for the policy and add 5,000 rupees over and above that as premium. So that means you'd pay 30,000 rupees annually. The insurance company expects to make 5,000 rupees per policy per year. Now, this strategy works when they have a large number of policy holders. And once they have that, once they have the probabilities in their hand, they aim to reduce risk by writing as many policies as possible. That's their objective. Now you understand the probability and we know what the probability is. Let's write as many policies as possible so that our risk is diversified. That's why they diversify into various types of insurances as well, like real estate, cars, and businesses. When the odds are clear, it becomes a numbers game. You won't want to take out a single policy on one person because the risk of that one person encountering a disaster is too high. It's what they call a black swan event. To mitigate this risk, insurance companies write countless policies, collect premiums from many people, and then spread the risk. If one person's life takes a tragic turn, it won't devastate the company's profitability. Insurance companies want to underwrite as many possible policies as they can, which is why the insurance business is so competitive. It's exceptionally profitable when done right. So they want as many policy holders as possible, each of them. So with all this in mind, what do you need to know to make money from the market? you obviously need to just follow the same logic. Become the casino, become the insurance company. Now, here are 3 key takeaways to make sure you understand the implications of how casinos and insurance companies work and how you can apply this to your trading as well. So number 1 is know the expected probability. Understand expected values and understand probabilities. So just like in casinos and insurance companies, we must know the expected value and probabilities in our options business. Imagine if you knew your chances of winning or losing in every roulette or blackjack game. Would you still play? Many people enjoy the thrill of gambling, but when viewed as a business, it's not a sound strategy. Similarly, in the insurance business, understanding the probabilities of various events is essential for probability. We need to know these things in order to succeed in options trading as well. The second thing that we need to look at is keeping our position sizes small, limiting the size of our trades. Both casinos and insurance companies limit exposures by keeping positions small. Casinos set table limits to ensure players bet relatively small amounts. Insurance companies diversify their portfolios. They spread risk across a large number of policyholders, and each individual's exposure is limited, whether it's to the risk of death, property damage, or other events. In options trading, it's crucial to manage risk by keeping position sizes in check. And lastly, consistency. Take all the trades. Consistency and frequency are key in any business. Casinos only become profitable when people keep coming in to play those games, and they need to play those games repeatedly. After thousands of play, they are almost guaranteed to make money. The same goes for insurance companies. They don't make a significant profit with just one policy, but rather through the consistent collection of monthly premiums from a large customer base. The larger the customer base, the more valuable an insurance company is. It doesn't matter what the size of each of those policies are. In options trading, maintaining a consistent and frequent approach is essential for long-term success as well. And these principles help us apply the same logical thinking that drives profitability for casinos and insurance companies to our option trading as well. And this consistency and frequency leads us to profit. It shifts our focus or shifts us from being a gambler to becoming that casino. From an amateur outlook to a professional business outlook. And from that retail trader to the institutional traders. Remember, the institutional traders are the ones that make all the money that is being made in the stock market. Now, to take this forward, let's dive into implied volatility and how it connects everything that we've learned so far to define our edge as options trader. Implied volatility is derived from the options prices and shows what the market expects the volatility to be in the future. Implied volatility is a crucial concept, and as I said, it's derived from an options price. It essentially reflects what the market anticipates about a stock's future volatility. So typically it's based on at-the-money call and put options, which are usually the most actively traded and thus provide valuable insights. But here's the key idea. When the market expects a significant future price swing for a stock, options on both sides become more valuable. Why? Because traders foresee a higher chance of the stock moving into a profitable range. Now, before we continue, remember that factors affecting options prices are known. All factors like time left until expiration and intrinsic value, the difference between the current stock price and the strike price, those are predictable. What remains uncertain, the implied part of it, is volatility. It's essentially an educated guess based on how much the market anticipates the stock will move. So let's do this. Let's review volatility through a visual example. Imagine that the stock price is 100 rupees. In a low implied volatility, the stock moves in a tight range around 100 rupees. So options with a strike price of, let's say, 110 rupees likely will not be in the money or profitable because there's a very low chance the stock will randomly spike to 110 rupees. Consequently, the price of those options is going to be relatively low. So to draw a parallel, think of buying a lottery ticket. The likelihood of winning is minimal. So the tickets are priced very low as well, typically 10 rupees or 15 rupees. In contrast, a high implied volatility, right, something that moves like this, means that the stock is swinging widely around 100 rupees. In this scenario, a 110 rupees strike call option has a decent chance of becoming profitable at some point. So consequently, the value of that option surges. High implied volatility boosts the value of options on both sides of the market, whether calls or puts, because there's a higher likelihood of the stock moving into a profit zone. Now, the good news is that implied volatility can be determined. Most trader platforms, broker platforms, typically provide this information. So you don't really need to calculate it manually. You can determine it by looking at the charts that are given in your broker platform. Let's see how that works. And you can see this in your broker platform. We are here in Definite Securities Opstra platform, and very quickly I'll show you how we see the IV charts as well. The charts are the data regarding charts. It's very easy to see what the current level of implied volatility is. And if I just scroll over, this is the end of day IV charts. And if I just scroll over for the look at the 1 month performance, and you can just see over here the implied volatility is at 10.99 or 11 points. So we can track this as we go along. We can do it at the intraday level as well. Exactly what that implied volatility is, you can see in today's market. The market opened at about 11.3 IV, went down, fluctuated this much, ranging between a low of somewhere around 10.95 and a high of about 11.45. So we know exactly what the IV is doing, and we can do this for all charts. You can look at ACC, for example. ACC started at about 27 in the morning and then has gone down at the close of day today to 25.76. Bank Nifty, same thing. We can look at where it started off. This is where it started out, 13.32, and ended here at 12.86. So not just in terms of the days level, we can, while we are entering the strategies, while we're making those strategies in the live market, we can do that. We can have a look at exactly what the level of implied volatility is. The broking platforms are tracking these numbers so that we as options traders are able to take a very calculated call on what strategies we want to position. So hopefully that clarifies how you want to get the implied volatilities. Now, one last thing to note is that when we apply or when we work with implied volatility, we typically assume a normal distribution. Now, this might stir some controversy, especially among those new to options or stock trading. However, it's a widely accepted approach in the industry. Now, let's address the common assumption that the market doesn't follow a normal distribution. I'm going to demonstrate why it actually does and how we use this understanding. We take the probability we discussed earlier and apply it to a normal distribution. What does that mean? It means that 68% of the time, the stock will move within the expected range. This is the expected range, 34.1% plus 34.1%. This is what we refer to as a 68% probability range. It spans one standard deviation on both sides, on either sides of the market, on either sides of the current market price, right? Assuming this is the current market price. In other words, it's a range that the market is expected to stay within about 2/3 of the time. So to address the question of whether the market behaves like a normal distribution, we conducted an extensive analysis. We examined the daily percentage move in the Nifty over the past 26 years, starting from the time of this video. We then plotted these movements on a chart. What did we find? The chart revealed a clear normal distribution, if you can see right over here. While there are outliers where the Nifty experienced significant gain or losses over a few days, the majority of moves fell within the confines of a normal curve or bell curve shape. Now, even around the zero mark, you'll notice an almost equal number of occurrences where the Nifty moved up by a small amount and down by a small amount. It's nearly balanced. This doesn't mean that markets can't experience longer-term trends or positive skews where gains outweigh losses, but it does highlight that on a day-to-day basis, market movements tend to follow a normal random distribution. So this principle also holds true for any liquid market out there, and it's an essential concept to grasp for options trading. So we did the same for Bank Nifty, had a similar curve. For TCS, had a similar curve, although it was more restricted, so the volatility was a little lesser, and Cipla had a similar curve as well as the Kitex garments, which are smaller small cap stocks, mid cap to small cap stocks, as well as Astral Poly. So all these showed this bell-shaped curve that we spoke about. So let's understand this further by looking at an example. Let's look at a stock trading currently at 50 rupees with an implied volatility of 20%. Using the principles of a normal distribution, we can assume that 68% of the time in the future, the stock will trade between 40 and 60. Why? Because 20% of 50 is 10 rupee move in either directions, which results in 40 and 60 rupee range. So this is likely to be in this range with a probability of 68%. Now this has great ramifications for us, as we'll see in subsequent slides, because this lays the foundation for high probability trading. Now, so what we do is we gather these data points, establish the expected ranges, and build a high probability trading system around them. Think of it visually. If a stock is trading at this level, let's say this is 50 rupees for ease, and it has a 20% implied volatility, there's a 60% chance it will be between this range. A 68% chance it will be within this range. So as time progresses, the expected range might widen. But when we look at the next few days, there is a quantifiable probability of where the stock might end up. Now, the critical difference between options trading and stock trading is that we have this range of expected outcomes rather than just hoping for a single direction, like in stock trading. Now, when implied volatility increases, Vega, as discussed in previous videos, an options price rises to account for the higher probability of the strike being in the money at expiration. This is why we sell options when implied volatility is high and buy options when it is low. And as it increases, as IV increases, the area of potential movement of the stock prices increases. So option prices increase to compensate for this increase in the probability of expiring in the money. Now, low implied volatility results in a narrower distribution of prices, where most prices fall within a limited range. On the other hand, high implied volatility results in a wider distribution of prices, where the stock has a greater chance of moving over a broader range. Implied volatility represents the market's expectation for a stock's future price volatility. It is absolutely a critical factor in determining options prices. So think of implied volatility as the market's best guess about how much a stock's price will fluctuate in the future. When implied volatility is high, it suggests that traders anticipate significant price swings. Conversely, when it is low, the market expects relatively stable price movements, which is also why when there is a sudden movement in price, suddenly the IV starts moving up, because then most view on the market becomes a lot more volatile. So then suddenly the implied volatility, which may have been at this level, suddenly becomes a lot broader. So the expectation becomes that the price can fluctuate a lot more than was earlier anticipated, which is what we need to constantly have a view on, have a handle on as we trade options. Now, understanding the difference between expected and actual move is really where our edge as option sellers come in. This discrepancy is how we make money at the income option, as the market often overestimates the stock's actual movement in the long term. So let's dive into deeper into this concept of implied volatility and how it actually relates to options trading. As I said, implied volatility tends to overstate the actual expected move in the stock price in nearly all cases. We start with the assumption that markets are efficient, and they are efficient. We've seen it over the years that we've been working with the market. All news, any news gets adjusted in the price very, very quickly, creating a very stable, a very efficient system of operation. So there's no real advantage in picking stocks for directional gains. Over time, this gets offset. In options, selling high implied volatility positions is a real market advantage. That's really where our edge as options traders comes in. So if you know the expected values and probabilities, you can build a business system. And we saw this in the case of casinos and insurance companies. Since they knew the values and probabilities, they were able to build that business system around it. Likewise, as options traders, since we now know the expected values and probabilities, we can build our business system as well. And we see this in the builder platform, in the broker platform. If you go under options, we see IV charts, and right off the bat you can see over here the price movement, but down in the lower part, in the second chart, the lower charts, you will see the implied volatilities and the historical volatility. Very quickly, I'm going to look at the year-to-date performance of Nifty. We look at other scripts as well, but very quickly on the Nifty, this is the implied volatility in orange, and likewise this is the historical volatility in the purple. And as you can see very quickly right over here, the orange is much higher than the purple line. So this is the orange line, this is the purple line, and if I move it out, you can see that it always stays above the purple. The orange is always above the purple. There are times when it does cross over, like right over here, but then it does come down over here, implying that basically the market's anticipation or best guess as far as implied volatility is concerned is lower than what actually lands up happening, the historical volatility. And you'll see this not just in Bank Nifty, but also in not just in Nifty, but also Bank Nifty, for example. The same thing happens. You have the implied volatility at this level and the historical volatility at this level, staying lower most of the time and crossing over sometimes, but mostly it stays. The historical volatility stays below the implied volatility. Again, so showing that the market's anticipation of volatility is usually higher than the actual volatility that happens. Same is true for other stocks as well. Let's look at ABB just as an example. So you have the implied volatility again in the orange and the historical volatility in the purple. Again, staying lower, historical volatility staying lower. Yes, there are times like over here, where it crosses over, but as you can see, it quickly comes in, and more than 70% of the time, historical volatility stays below the actual volatility. But what does all this mean to us as options traders? That's a very valid point. What does all this information mean for you as an options trader? Well, here's the key takeaway. Options prices are significantly influenced by implied volatility, which represents the market's expectation of future price movement. When the market expects high volatility, options prices are inflated, and when it expects low volatility, options prices are deflated. So if the future moves turns out to be less than the expected move, and really this is where everything turns around, if the future move turns out to be less than the expected move, then the option is overpriced. And on an average, IV is higher than the historical volatility. The crucial insight here is that this expectation of future movement is often overstated, is much higher than the actual price movement of the underlying asset. So what the market expected to happen, implied volatility, and what actually happened, historical volatility, is different. And implied volatility is much higher, is higher on an average than historical volatility. And as a result, in the long run, all options are theoretically overpriced, to some extent at least. This overpricing occurs because implied volatility is consistently higher than historical or actual volatility. So as a result, traders who are net options sellers have a mathematical advantage, meaning they sell options. By selling options more than we buy, we have a distinct and mathematically proven advantage over traders who primarily buy options. This is a fundamental concept that you cannot dispute, and this has been demonstrated across various examples. However, it's important to note that this doesn't mean option buyers can't make money in specific situations. There will be times when the market underestimates volatility and option buyers may profit. Nevertheless, in the long run, option sellers hold a significant advantage over options buyers. So in summary, as options traders, we must follow the same logical principles used by casinos and insurance companies, which is to know our expected value and probabilities. Remember, this is a numbers game. Recognizing the consistent overestimation of implied volatility compared to actual volatility provides us with that edge, a substantial advantage in the options market. So what we need to do is understand the implied volatility and its impact on options pricing, and this is a fundamental concept for successful options trading. And what we've covered in this video is that, number one, what we need to do is know the expected probability. Implied volatility consistently is overstated. It overstates the expected move of an underlying asset, and this overpricing of options is a crucial edge for option sellers in the long run. But we need to limit the size of our trades. To minimize risk, it's absolutely essential to keep positions and investment sizes small. This risk management strategy ensures that unforeseen events, similar to black swan events in insurance, don't have a catastrophic impact on our portfolio. And finally, we need to take all the trades. Just like the casino, we need to take the other side of all the trades as where our advantage exists, where our edge exists. And consistency and frequency are key to long-term profitability in options trading. So, as I said, just like casinos and insurance companies, we also rely on volumes, and as options traders, we benefit from that persistence. The takeaway is that options trading at its core is a game of numbers and probabilities, and by applying these principles and understandings, and understanding where your edge lies, we can approach options trading with a well-defined strategy and increased confidence. Consistency and frequency leads to profits. So as you continue your journey in options trading, the income option offers more in-depth resources and guidance in this track, in the next track, and the future advanced tracks that we are coming up with, where you can explore how to find trades, place them, manage risk, and address other questions that you may have. For now, if you have any questions or comments about the content that we've covered in this video, please feel free to share them in the comment box below this. Additionally, if you found this video valuable, sharing it with your friends and family can really help spread the knowledge of successful options trading and really spread the word for what we do here at the Income Option. Thank you for watching, and until next time, happy trading.